Welcome to the Zandbergen Report, where wealth strategies and pop culture collide, featuring your distinguished host and certified financial planner, Bart Zandbergen.
And hello, everyone. Welcome back to the show. I'm excited to be back in studio again this week with Strider Elass. He's a senior economist at First Trust and part of the First Trust economics team that Bloomberg has consistently ranked as one of the top forecasters of the U.S. economy over the past decade. Strider, welcome to the show.
Hey, thank you, Bart. Welcome. It's really great to be with you.
Oh, awesome. Well, there's a lot going on, I think, in the market and in the economy. So you're the perfect person. I don't know. We talked about a bunch of things. Let's talk with tariffs. What's your thoughts on them? Just kind of maybe in general. I mean, historically, tariffs, when permanently are in place, I don't think fared very well for the economy. But then again, maybe what's going on with them and what you think will happen as this all settles.
Sure. So I think we have a very good case study of this. Obviously, when Trump was president the first time around, he wanted to put tariffs on countries. And I really think it goes back to and I think he's thought this way majority of his life, is that it's just not fair that when you look at the United States and the rest of the countries that we do business with, on average, especially our top 10 trading partners, every single one of them has higher tariffs on goods coming into their country than we do on goods coming into ours. And so I think his viewpoint, first time around anyway, when he was president, was, hey, either you lower your tariffs to get more in line with us, or we're going to raise our tariffs to get more in line with you. And I think he was really playing with fire. I personally do not think it's a good idea to use tariffs as a policy tool. But, credit to him, it worked the first time around. And we actually saw every single country that we signed trade agreements with today have lower tariffs on goods coming into their country than they did back in 2016 before he was president. And so now we look at kind of this tariffs 2.0 with the new president. And I think what he wants this time around is different than just seeing lower tariffs across the board. It really seems like this time he wants to bring in revenues from tariffs. And he says other countries are the ones who are paying these taxes. It's not the American citizens. But the reality is that it does fall on the American citizens. It falls on small businesses, especially that are just trying to make ends meet and importing from these other countries that have to pay these tariffs coming in. Whether or not they can pass it on to their customers, we'll see. But I think the biggest issue today is not so much the tariffs, but it's more the uncertainty surrounding the tariffs. We don't know if tariffs are going to be 145% on China, if they're going to be 30%, if they're going to be 10% for the rest of the world, if they're going to be higher, if they're going to be lower. And this is my issues are minor compared to what others are dealing with. But just to give you an idea of how frustrating it can be, we put out a piece every Thursday called 3 on Thursday, and I was writing it last week, and I decided to do it on tariffs, just an update on where things were. Well, couldn't be worse timing to write a piece on tariffs because it's got to go to compliance first. And so have it all done by Wednesday. Yeah. And then Wednesday evening comes around and we find out that basically Trump's tariffs that he's put on, majority of them have been said to be unconstitutional. And then they said, okay, we're going to immediately remove tariffs on companies for these unconstitutional tariffs. So Thursday rolls around the morning. You're trying to put this all together, rewrite it, do that. I'm on a flight by the afternoon. On my flight, I read again that not only are they're still said to be unconstitutional, but now they're back in place because they're able to put an injunction or whatever you call it in place that until they figure out the overall scope of what's going on, you have to continue to pay them. So then I had to go back and rewrite the piece again. I mean, all this to say, if I'm just writing a piece, I'm not even in the customs agency, but if you're trying to bring in customs duties, say you're sitting there at the docks and you don't know if the tariffs are on or off or what you should be charging for all these goods that are coming in. And then if you're a company trying to make decisions on whether you should purchase products now or wait and so on and so forth, I mean, the amount of economic uncertainty that this has caused is extreme. And to me, that's the biggest threat right now, is just the uncertainty from the tariffs more than even the tariffs. Although I do not believe higher tariffs are a good thing for the U.S. economy whatsoever.
Yeah, interesting. Well, like you said, we'll see how it plays. And he has been successful in, to some degree, because there has been some negotiating, and we'll see if these negotiations play out as planned. But, interesting. Yeah, I meant to lead with another question, so I'm going to backtrack.
Sure.
You're an economist, and so how do you start your day? What's the first thing you do or read, or how do you get prepped for every day?
Sure. Yeah. The reality is every day is pretty different, and I do a lot of traveling too. So it really depends, but I always try and start off at least with reading some of the big newspapers, see what's going on, if there's anything new. The problem today is no matter what newspaper you're looking at, there's just a lot of political slant one way or the other. And so I think you have to really dig through to get the underlying data or the underlying opinions that really matter or that really have impacts on the overall economy and the markets. But for me on a daily basis, I mean, there's a lot of data that comes out, not every day, but a lot of days. And so we're putting together reports on that data that comes out early in the morning, looking at those indicators, figuring out how they're impacting the economy, how it impacts overall GDP moving forward, and where the consumer, where businesses currently sit, so on and so forth. And so mornings are usually fairly busy just with catching up on the world and seeing where things are going. I think really Wall Street Journal still I find the most valuable.
I was going to try to push you for your favorite. So you still like Wall Street Journal?
Yeah, Wall Street Journal is still probably my favorite to look through. I really enjoy, I've got a Bloomberg subscription, which most people don't have the benefit of having. I'm fortunate to have one, and the articles on there are really good too. And I think they're for the most part nonpartisan. So it's a good place, a good source.
Yeah, it is a tough one because you'd have to siphon through that. But I get it.
Yeah.
All right. GDP. We were talking earlier that this is first negative GDP quarter in quite some time. So what's your take on that?
Yeah, and again, I think very politically driven on both sides. You have the left that's saying, look, the president has already driven the economy into a recession. We had a negative quarter, worse things are to come. And you have the right saying, well, no, this is what Joe Biden left us with, and the president's just getting this through, but just wait for the second quarter because it's going to be huge and his policies are really going to start to take place. And so is any of that really accurate? I don't believe so. I think it's very clear what happened in the first quarter. And again, it goes back to tariffs and really what companies did, or companies that were able to, and most of those are the larger companies. It's not really the smaller companies, but what most companies did was they were able to pull inventories forward. And so they imported an unbelievable, it really was unprecedented amount of goods in the first quarter, bigger than we've ever seen. And so what happens when you think about GDP, it's gross domestic production. And so it counts everything that we produce in the United States. So when you look at imports are counted as a negative because although we're consuming them, we don't produce them in the United States. Exports, although we don't consume them, but we produce them, are counted on the positive. So you always look at exports minus imports. And what happened was in the first quarter, we saw a surge of imports like we have never seen before in history as companies tried to get ahead of tariffs because they had no idea what was going on. And so that counted as a massive negative towards GDP.
Interesting.
Just imports alone took off 5 full percentage points to GDP growth. Just imports alone. So
equivalent to a medical false reading, maybe this GDP due to, it was the number was real, but kind of a false backdrop because of the oversupply of imports.
Yeah, and I think that's, so you look at the second quarter, basically we're going to have a huge payback now because we're not going to see near the surge of imports that we saw in the first quarter. And so what's going to happen is that we'll probably see a second quarter reading for real GDP that could be 4, maybe even 5%. You look at the Atlanta Fed right now; they're forecasting, I think, around 3.8% for the second quarter. But I mean, it can be anywhere. It could be all over the board. Everything's going to depend on what happens with trade for the second quarter. But from what we've seen so far, it looks like imports are going to actually count as a huge positive this quarter because they're going to be a lot smaller than where they were. What I would say is that what's really important when you look at GDP, there's really 3 areas that you want to focus on. It's what we call core GDP. It's consumption, it's business investment, and it's residential investment. Those over time are what really drives growth. And that core GDP measure was up at about 2.5% in the first quarter, pretty consistent to where it's been over the last 20 years or so. So although we had a negative reading, what really matters showed that nothing really had changed. And I think the same thing's going to happen in the second quarter where we have another solid reading for core GDP, but the overall reading is going to look even better than what that core reading looks like because imports are, again, going to play a role, but it played a role to the positive side this time, not to the negative side.
So recession fears probably not warranted at this time?
Yeah, I don't think so. There's nothing that's really screaming recession as of today. We're still very weary that there could be a recession in the next 12 to 18 months, and it really has very little to do with any policy decisions that the president's making, but really just has to do with really the policy decisions that were made back during COVID and the massive stimulus and spending that took place. It was like this artificial sugar high. Well, eventually that runs out. And we just believe that this is the year where that's finally run out. And so it's just going to be harder to continue to grow and continue to see things move forward at the pace that we've seen without all that stimulus. And the reality is that at some point it runs out. There's no country that's ever been able to grow themselves to prosperity through government spending. The private sector productivity gains, that's what really drives growth. And that's where we need to get back to. And I think this president is pushing forward policies that will start to move us more from government back to the private sector, which I think is a huge benefit over time.
Okay, with that said, then let's kind of go into the market. I'm thinking back last time I saw Wesbury, who's he's your lead economist, right? Your
chief economist.
Chief economist.
Yeah.
He wasn't quite bullish. Matter of fact, he was a bit on the bearish side. Do you or he or does the firms take that same position today?
We do, yeah. I completely agree with them. I think, and what he would say too is just the market has gotten ahead of itself. It's not to say that there are not unbelievable companies in the S&P 500 because there are. And a lot of them are still growing at pretty good clips. But the reality is that it just seems like things have gotten overextended. We came into this year, basically by any metric that you looked at on the S&P 500, that the market looked to be overvalued. Now, again, on top of that, analysts were expecting that the market was going to grow this year price-wise by at least 11%, and that earnings were going to grow double digits again this year. And I think in a environment where we have an economy that looks to be, still is growing fine, but looks to be slowing to some degree. And I think in the future quarters, we will see it slow down a little bit further. And we're starting to see some signs in employment and whatnot. I think it's very hard to see double-digit earnings growth again this year. And a market that's already priced to perfection, if you don't get what the market is expecting or what analysts are expecting, then I think you will start to see some volatility. We've had a bunch this year so far, and a lot of it people would say is caused specifically by tariffs. That may be true, but either way, I think we're going to see further volatility just because the market itself, I think, has run too far, too fast. To give you an example and something that's better anyway, is that we're finally starting to see some market breadth. after really a couple years of a market that's been unbelievably concentrated, really driven by those 7 companies that we call the Mag 7. But this year so far, really through yesterday, we've actually seen the Mag 7 as a negative contributor to the S&P 500. You look at just those 7 companies, and together they've actually taken away from the overall market about 1.43 percentage points. So the other 493 companies have actually grown, seen price growth this year so far of about 2.43%. So overall, the S&P is up about 1%. So, and it's been all those 493 companies that's really been driving the growth. And so, to me, that's a positive sign. But still, I think those Mag 7 companies, unless they can continue to grow earnings substantially, are going to start to slow down. And really, if the other 493 don't pick it up in a big way, I think we could see some downward pressure on the market here.
All right. So bold question. What's your expectation for the market by the end of the year, positive or negative?
Sure. I think we'll be flat to down actually on the year. Our forecast at First Trust, and the way we do our forecast is we use a model. It's called a capitalized profits model, and it looks at earnings. We use economy-wide earnings, not just S&P 500, but economy-wide earnings, and we use the 10-year Treasury as our discount in that model. And we go back to the 1960s and basically look at every single quarter and say, if the relationship that we have today held throughout history, what would fair value for the S&P 500 be today? And what that shows is fair value is somewhere around 5,200 for the S&P 500 based on where corporate profits are and where the 10-year Treasury is today. And so what that tells us is that the market looks to be overvalued. Our forecast is 5,200 just because that's kind of what our model says. And when we came into the year, we thought, this is about where we think things could go. But does that mean we'll get there? Maybe, maybe not. But what it tells us is that we believe it's going to be a little bit of a tougher year. So whether we hit 5,200, we already hit it obviously this year, but we've bounced on strongly from that. Whether we end up there or not, I'm not sure. But I just think it's going to be a tougher year in general. So I'd say probably flat to down for the year.
Okay. All right. And of course, when we talk about the market for the audience, that's the stock market, S&P 500. Doesn't mean a portfolio.
No, yes, exactly.
Yeah.
And I think, and that's the thing, is I think a lot of portfolios will do a lot better than the overall S&P 500 this year because so much of the growth, again, has really come from those 7 companies that in most portfolios, you're probably not overweighted in just those 7 companies where the S&P 500 is. So if the other 493 companies do a lot better, then overall, I think if you're more diversified, you're going to do better than the overall S&P 500 this year.
And let's also add international markets that about performed the U.S. so far this year.
Yeah, big time. Yep.
Yeah, which for the first time in I don't know, 10, 15 years.
Yeah, I think diversification really is, in an environment where we think things are overvalued, I just think diversification really is key. And it's more important than ever, I think, to have a financial advisor because there are so many options out there, so many different types of products, and there's a lot of incredible new financial innovations that you can put your money into now that the general public just doesn't have access to or have the knowledge about, that a financial advisor can walk you through, and you can mitigate downside risk and still have upside potential. And it's pretty amazing where things are today.
We've been really happy, and more important, our clients have been really happy this year, given the concern, especially what the news networks get paid for flash news, right? And so negative markets, they get paid. Clients got a little bit panicky, but I've touched about every client, had quarter reviews or ad hoc reviews, and everyone's left pretty happy. So
that's wonderful.
Diversification pays.
Big time.
You and I talked about government spending. What's happening there?
Yeah, I think it's very interesting because we came into this year, the first quarter at least, with the Department of Government Efficiency and high hopes that we'd see substantial spending cuts, and that actually saw a lot of people worried. They moved pretty quickly from, okay, government spending too much to now, is government going to be spending enough? Are we going to be thrown into this massive recession? And are we going to see, Elon Musk said he thinks he can cut $2 trillion from $7 trillion of government spending. Well, the reality is that it's not really a possibility. When you look at mandatory spending that happens every single year, it makes up about 87% of all of government spending. So you have about 13% of government spending that's left that's kind of discretionary, non-defense spending. I mean, even if we cut all of that tomorrow, which we won't, but even if we cut all of it tomorrow, within 4 years, those mandatory programs' growth rates would overtake all of those spending cuts. And so if we do want to get serious about cutting government spending, we do have to wade into those mandatory programs and figure out ways to make them way more efficient. I think there's definitely ways to do that, and maybe the Department of Government Efficiency figures that out over time. But many presidents have tried this in the past to figure out ways to cut government spending. And the biggest holdup has really been Congress. I mean, I think back to the 1980s when Reagan was president, he put in charge of a commission to cut spending, a guy named Peter Grace, who was the CEO of W.R. Grace. And he, along with about 160 other business executives for 18 months, figured out ways to cut spending. They actually wrote a book, put together a book for Congress and for the president. And after that 18 months, they came up with about $425 billion that could be cut in 3 years and lower the deficit by about that. While at the same time, they said if we do this by the year 2000, debt will be about $2 trillion. Well, if we don't do this, debt will be about $11 or $12 trillion. So you could see how big of an impact it would have. And Congress got all this information and they said, wow, this is amazing, great work. And they did nothing. They didn't cut any spending. And here we sit today with almost $37 trillion in debt and $2 trillion deficits, and the situation's even more dire. But the problem, again, is that all of these cuts will have to go through Congress, or majority of them anyway, will have to go through Congress. And so will it be different this time around than it's been in the past? I'm hoping it will, but I just don't think that it will. The thing that I think we have on our side this time that we didn't in the past is social media and the internet and X and the platform where Elon Musk or somebody else can show spending that has just been abused or fraudulent and can post it. And if you get enough people upset with that or aware that this is going on and a bill goes to Congress and they don't pass it, well, I think those officials that voted against it are going to be in some hot water, and we'll have a hard time running in the future. So I'm hoping, but is it likely? No. Is it possible? Yeah. Probable? No. So I think the spending cuts that people are imagining are way overdone. And in fact, I think spending will actually continue to grow, not be actually cut.
Okay, interesting. All right. Let's go back in time.
Okay.
I know that you helped and contributed to a book called It's Not As Bad As You Think. Back from 2009, you worked with Brian Wesbury. Tell us a little about that.
Sure, yeah. It was written by our chief economist, and I was just the grunt on it, helping him with writing or figuring out all the charts and getting all the data and coming up with some ideas. And it was a great book, but we got a lot of flack during the time, or he got a lot of flack during the time, because if you remember we published it, I think it came out for him in 2009, if I remember correctly, but it was 2007, 2008, or really it was 2008 when he was writing it.
Yeah, it's a big one.
And you remember Press 8, yeah, I mean, no matter what positive data came out, somehow people said, well, this isn't going to last. We're going to have a double dip recession. The world's coming to an end. We're never going to get through this, so on and so forth. And the book, It's Not As Bad As You Think, was just looking at the data and saying, look, here's the data and things are improving here. We're having this V-shaped recovery, and it's time to get back into the market, in the stock market. And the reason being is when you look at really what took place over that period of time, so much of it was, we believe, government error. A lot of it was due to mark-to-market accounting and the fact that it was put back in place, and that turned an issue with mortgages into an absolute catastrophe. And it wasn't until mark-to-market accounting was removed that the market bottomed and that we actually started this recovery. And so it kind of goes through that whole period of time. Highly recommend reading it. My boss, Brian Wesbury, he's just an incredible thinker, very good with words, and is able to take complex ideas and simplify them. So if you're interested on what really went on, or what we believe really went on during that period of time, I highly recommend taking a look at it.
Oh, yeah. Thank you. Thanks for sharing that. Anything else that you think we should cover that would be interesting to our listeners?
Yeah, I'd just say, lastly, when you think about where interest rates are heading here, I think that's another big issue for a lot of people. They're worried about, is the Fed going to cut? Are they not going to cut moving forward here? When you look at the overall perspective right now from the market, we can look at Fed funds futures and gauge what expectations are for rate cut. We call that what the market believes. And right now the market is pricing in 2 rate cuts by the end of the year. The first one taking place in September, the second one taking place in December. Will that happen? I don't know. I tend to believe that the first one will start to take place in September. When you look at the Fed's dual mandate, it's full employment and stable prices. And we're really back down to about that 2% level for inflation is what the Fed would like to see. Their favorite measure that they look at is PCE price indicator, and that's down to about 2.1% year over year. So pretty much right there. And at the same time, I think we are starting to see employment slow to some degree. And so we believe that the Fed could cut rates today and it wouldn't cause inflation to skyrocket. And I think it would be positive for the economy, as we believe it will be slowing into the second half of this year. So getting ahead of it would be a huge benefit. Will they do that? We'll see. Usually the Fed's behind the 8 ball, but there's always the chance. And I think the data is showing clear enough that, hey, inflation's coming back down. Inflation's really a monetary phenomenon. It's driven by M2 growth, and we've seen M2 stabilize. In fact, it's about the same level. Money supply is about the same levels where it was back in 2022. So I think it's time that the Fed can start to cut. So moving forward here, I wouldn't be surprised if we see a couple cuts this year, and then into 2026, I wouldn't be surprised if we see a couple more cuts. All in all, I think for what that does to short-term rates, obviously, it will bring them down 50 to 75 basis points, depending on how many cuts we have this year. But on the longer end, too, I think we'll start to see rates come down to some degree. The Fed doesn't control that, and recently we've seen the longer end go higher. But I think as people realize inflation looks to be under control, that tariffs aren't going to cause a big spike in inflation. And on top of that, the economy is cooling down to some degree, that will be a welcome sign. And I think longer term rates will start to subside a little bit as well.
Yeah. All right. Well, that's great news. All right. Well, I definitely want to thank you for taking the time. I know that you carry a pretty busy day, and following Brian around, that's got to be time consuming as well. So thank you.
Well, it's my pleasure to be with you.
Yeah, great. Now I'm going to have one final closing question for you. Okay. So if you could create a billboard, what would it say?
Ooh, that's a really good question. Well, this doesn't have anything to do with economics, but my grandfather was one of my heroes, and he passed away a couple years ago, and I was going through his stuff, and I found this little piece of paper. And on the piece of paper, it said, "I noticed, ... treat everyone as if they're lonely." And I think that's a really profound thing, but I feel like that'd be a great billboard. I notice, treat everyone as if they're lonely, because people are always dealing with something, right? And if you can just treat people in a positive light and just show them that you care about them and notice, it'll go a long way, especially in this world where we're getting more and more inundated with AI and technology, which is a wonderful thing, but I think it causes more and more seclusion and more loneliness. And so that would be my billboard.
Thank you for sharing. That's really nice. I like that. Thank you.
Yeah. Well, maybe we'll put a billboard up sometime.
Let's do that, Strider. All right. Thank you again, Strider. Thank you for everyone who has tuned in. We look back to being in the studio soon. Cheers.
Great to be with you, Bart. Take care.
Thanks.
Tune in next week for the latest edition of the Zandbergen Report, Tuesdays at 2 p.m. Catch up on our recent shows by visiting podcast.bartzandbergen.com. The Zandbergen Report is also available on iTunes, iHeartRadio and Spotify. Interested in being a featured guest on our show or have a question you'd like to hear us answer? Email podcast@bartzandbergen.com. The contents of this podcast episode do not constitute an offer of securities or a solicitation of an offer to buy securities and may not be relied upon in making an investment decision related to any investment offering Access Wealth Management LLC, an SEC-registered investment advisor. Access does not warrant the accuracy or completeness of the information contained herein. Opinions are our current opinions and are subject to change without notice. Prices, quotes, rates are subject to change without notice. Generally, investments are not FDIC insured, not bank guaranteed, and may lose value.